Welcome back, folks. We had the Dow finish down 392, NASDAQ off 146, S&Ps down 54. Now we have our man, Mr. Sean Wright. Folks, Sean, his partner Gavin, and our man, Mr. Andy Heck, wrote an article together. This is on Seeking Alpha. It's the top 10 reasons why the stock market will tank in 2016. Now, this article, by the way, was written before we start plunging at the beginning of the year. We got our man, Mr. Sean Wright. We're going to talk about what those reasons are. Sean, welcome to TFNN.
On.
How you doing?
I'm doing great.
Good, man. Well, listen, thanks for coming on, number one. And Sean, folks, Gavin and our man, Mr. Andy Heck, they are with Carden Capital. Carden Capital and Carden Futures. And at the beginning of the article, which is pretty cool, you know, they have that 14 banks are saying that in 2016 we're going to be up 6.5%. And you guys are making a case that, you know, they're dreaming, right?
Yeah, we basically, you know, we saw that article and we thought these guys are just going to be dead wrong. Obviously, they're writing it because they got to keep their clients excited.
Yes.
You know, they got to keep the Muppets like interested, right?
Right.
But you know, when you look at it, I mean, our market timing signals have been telling us for a long time to be cautious, and when you then combine that with all the other qualitative factors that are out there, you know, it just didn't look to us like there was any way this could be a strong year. There's so many arguments against it, and that's why we knew we had to put out this paper. What we didn't know, however, though, was that, you know, China was going to have 2 trading halts in the meantime. I mean, the timing just happened to be, you know, fortuitous.
How cool is that, right?
Yeah, you know, sometimes a blind squirrel finds a nut.
So first off, talk to me why you think that the market is going to basically, you know, go south this year.
Well, let's just start out with a couple basics. You know, the way we look at it is markets are cyclical, and, you know, humans have sort of this behavioral cycle, if you would, that kind of means that the economy is going to have a cycle every 5 to 7 years.
Sure.
So we went back and looked at the historical data, and what we found, this is, I mean, I think this is very telling. You can look at all sorts of other stuff.
Yes.
But we went back and we looked and we said, how many years in a row could you have an up market? We look back to 1871, that's all the data we had, and we found on average it's typically about 4 or 5 years for a bull run. But
Sure.
there are a few cases where it's longer. But actually, there's only one case where it's ever been higher than the last 7 years that we just had, and that was, you know, when Reagan, you know, stopped out inflation and interest rates went down so dramatically in the 80s. That was 8 years. The current 7 years from 2009 to 16, which were all up in a row, that also stands alone. There's never been any other time longer than these 7 years other than those 8 years.
That's a bet. Yeah, no, and that would make sense. That's pretty amazing, no doubt.
It's just a very relevant statistic. Let me just give you one other data point.
Yes.
Whenever, I mean, which you will know from your career, obviously, you know, because you have so much experience. Anytime you see a global M&A volume record,
right,
it's almost always a top signal. It's just like when the tallest skyscraper gets built.
Yeah.
You know, it's always the end of the cycle.
Man,
right?
how does that happen? Isn't that crazy? Think about that. I mean, that's.
You know, I'll tell you how I think it happens.
Okay.
Basically, you have to get a bullish period for a long enough time, you know, to where you basically have so many people that are willing to spend money that outrageous projects happen.
Right.
That's why it always happens at the very end of the cycle.
It's just amazing, too. And I guess that they've made so much money for so long, there's zero fear that's left, right? And,
right.
You know, and I guess, do you think, you know, this gets intriguing, folks. The reason being is that a lot of this M&A, they're using other people's money. You know, it's large CEOs, right? So and there's bonuses if they can get it done and get out, right?
Sure,
Yeah.
Absolutely.
Yeah.
It's all about using other people's money. Interest rates have been driving this. You know, same with stock buybacks, which is one of the things we mentioned.
Yes.
Stock buybacks are at a record. When are they usually at a record? Right at the end of the bull market. Why? Because, first of all, the companies have tons of cash. They're flush with cash. A lot of times they don't know what to do with it. And, you know, if you're a CEO and the market's just really not giving you what you want, and you got options that need to get in the money, what are you going to do?
Yeah.
Well, just turn on the buyback spigot, you know, make your own luck, right?
Yeah.
So that's really what's happening here. But, you know, one of the other reasons we found that, you know, that the market was probably likely at its top is just because the buyback index which basically is an index of the top 100 companies according to their buyback ratios, it's not outperforming. Most of the time it does. I mean, just logically speaking, right? If you got more buyback going on, typically you're going to do better than the index as a whole. When that starts breaking down, it's a very clear signal. That's been broken down since August.
So when you're setting up your strategy, for 2016, what exactly, it's kind of nice because you're in the futures market and you're in the capital markets and you guys can move, right?
Yeah, well, we're flexible. A lot of people who are just long only aren't.
Yeah.
So, for us, we've been hedged since, kind of the middle of December.
Yes.
And, so that's in like the stock portfolios that we manage. We're not taking market risk there, at least not at the moment, because our market signals aren't telling us to take any risk. It's just not a good time to take risk. I think, that's really where people need to be right now. Let's put it, there's no shame in sitting on cash. Right. When you see something starting and it's clear that, we're now through the bull market, you don't want to sit there and kind of wait for it to turn around. You got to give it time, right? It'll probably be a rather slow bottoming process, just like a topping process takes a while. Bottoming processes tend to go a lot quicker.
But it takes a long time to get down to the bottom, right? Exactly. No.
Well, but still, that happens a lot quicker than a bull market.
There's no doubt, man. There's no doubt. So, hey, listen, let me ask you. You're in San Diego, right? I know. Yeah. Now, where is Gavin?
Gavin's based in Denver.
He's in Denver. Andy's in Las Vegas. And you guys all teach at the university in Denver? Is that how you guys met?
The two of them do. I don't teach in Denver.
Okay.
But Gavin and I were introduced by a former colleague who I shared an office with at one point, and Gavin shared an office with at one point at different companies.
That's awesome, man. That's awesome.
Yeah.
And so when we're looking at here, let me see. Give me another reason. You just gave me 3 reasons.
Right. So let me give you a couple other reasons here. Earnings are not growing.
Oh, that's a big one, right? Yeah. Right.
The market doesn't go up if earnings aren't growing, right? When you invest in a company, you're looking at the future cash flow stream of a business, right? When it stops growing, it's just worth less. We've always said to people, when the market stops going up, it goes down, right? If you look at 2015 as a whole, the market really never went anywhere, right? That was a pretty good indication that eventually it was going to go down. And so we believe that we've now started a secular bear market. When you're in a situation where earnings aren't growing anymore, and margins are at their peak, which they also are right now, because margins are extremely high.
Yes.
The last time you saw margins across the S&P this high was in 2007. There is sort of a natural limit to margins that can be reached, across the economy as a whole. It just really, it's kind of just a natural limit, right?
And, I agree. And it's almost like common sense. When I look at a company like Apple, it's an extraordinary company. But, how do you keep growing? And it's amazing, as a public company, they destroy you when you can't grow. But it's like, okay, give me a break. They grew in an extraordinary way. And it's like, okay, how do you grow hundreds of billions of dollars, right? It's amazing.
Yeah. Absolutely.
Well, listen, man, it was a pleasure to have you on. Love to have you on again. And, of course,
thanks, Tom.
We're looking forward to listening to your partner, Gavin, and Andy at 5 o'clock.
All right. Sounds great. Thank you.
Thanks, Sean. Have a great one, man. Have a safe one. You stay right there, folks. We'll be coming right back.